Since we're dealing to this day with the after effects of the financial crisis, it's worth spending some time on this and to discuss what lessons we can perhaps draw from it. Treasury management does not take place in a vacuum. When you are inside your treasury, inside those four walls, and you're working on the various aspects of your activities, you can't simply ignore what happens in the rest of the world now, because even for a domestically oriented company, world events can now impact your activities. That's why I call this looking out the window to take preemptive action. If you see some nasty thing on the horizon or you're making your best estimates as to what that might be, taking some action is an example of how a good Treasury team will react to financial developments. And the Ford example is quite apt in that regard. And this global financial crisis was probably the most serious since the Great Depression. And the basic causes were that there was a massive increase in the extension of credit, and particularly in the real estate sector, which caused a extremely large bubble to take place, not just in the US, but in other parts of the world. And of course, also started to impact commodity prices and other sectors. Now, the developed markets were hit harder in some ways than the emerging or developing markets, at least in those initial stages. But you could say that maybe it started in the developed world and it started to roll on through into the emerging and developing markets, as we see what happened in the latest situation in China, where there has been a significant slowdown in economic activity, which we'll talk about later. So these aftershocks of the global financial crisis are still being felt, and these are in areas like the contraction of credit, the global phenomenon of slower growth, and bank restructuring with higher capital charges, and even now, to some degree, social unrest in countries where, for example, the split between the high earning parts of the economy and the lower earning parts of the economy, deep disparities in income are causing social problems. So even the most experienced actors in the market, i.e., central bank chairmen who know and watch markets for a living, were fooled or did not understand what was going on. Even Alan Greenspan, who was the former chairman of the US Fed, and Mr. Ben Bernanke, who succeeded him, both of them did not fully comprehend or appreciate how bad the situation had become. What we've entered, and this is in the view of one observer, is that we are in a kind of stable disequilibrium in the markets right now, where there's an overdependence on central bank policies to make sure there's an easy money policy, because fiscal policy has been so difficult due to the high budget deficits that governments are reluctant to indulge in additional spending to increase economic growth. There are potentially new bubbles on the horizon. We even see real estate starting to pick up speed again. There are these political problems occurring around the world. Companies and banks are hoarding cash and not investing as they would in normal recovery. And global policy coordination is looking a little shaky at the moment. If you look at the problems in the EU versus China versus the US, these are very different kinds of issues, but this policy coordination arguably should be even more important. So here we are, we're facing some T-junctions. We could go to the left or go to the right, or do well or not do well. In Europe, it's a question about reorganizing the EU to make it a more functional and unified activity, or are we going to have fragmentation with potentially a British exit of the EU? In Japan, Abenomics is under pressure. Is this going to work to stimulate the economy? U.S. political gridlock may be overcome finally by the presidential elections. And China is in a huge transformation of its economy from a import-export driven structure to a more traditional consumption model, as you would see in the countries of Europe or the West. So we've got some very serious issues ahead of us. Recently, some observers of this market believe that the regulatory tightening that took place over the banks was absolutely essential. And Stanley Fischer, who's the vice chairman here of the Fed, he said that this was absolutely imperative that the banks be required to hold more capital and that their risk taking be controlled in such a manner that we would not have a repeat of the 2008 crisis. So regulators were not blameless, but on the other hand, they had believed that the market would solve a lot of the problems that would normally take place. And in the case of 2008, 2009, the market acted, but not in the way that the central bank governors thought it would. The IMF, which keeps an eye on a very global level on what's going on in the world, they now are concerned also about emerging markets. Emerging markets have 85% of the world's population and almost 60% of global GDP. So if the emerging markets also start to weaken, then that could also bode very badly for the developed market. Then in this post-GFC world, we could be faced with what's called secular stagnation. This is a theory that's been around for a while, but recently Larry Summers has been talking about this. He was in the Clinton administration as well as the Obama administration and was the president of Harvard and a very well-known economist. His definition of it is that it's a shortage of demand with less than full employment and low growth, or an increasing propensity to save and decreasing propensity to invest. So this means that we just simply don't have enough demand to get the production capacity moving again that in turn would create jobs and stimulate growth. So we have very low inflation, we have very low interest rates, and this could go on for some time. And we have a recovery in the United States that's at least 7 years old, and the markets are not expecting a return to normal anytime soon. His solution is really only that of an expansionary fiscal policy, that the governments around the world, and this is not simply in the US, it could also be Europe too, can overcome this secular stagnation and get growth back on the track if they resort back to good old Mr. Keynes's stimulative approach to fiscal policy to prime the pump to get the economies moving again. So these are examples of observers of the economic and market situation that are signaling that we are still not back into a normal environment. And they believe that we will have to take stronger measures to stimulate world growth.